Okay, thank you, Nick and panel, for that discussion. We're now moving on to conventional banking finance. We're very fortunate to have a great panel with us today. Global heads of various shipping banks. Let me just read it from the agenda. Anastassia Tcherneva, head of shipping clients at ABN AMRO Bank, yep. Vassilis Maroulis, managing director, global head of shipping at Citi. Paul Taylor, managing director, global head of shipping and offshore, Soc Gen. Stephen Fewster, global head of shipping, ING Bank. And Christos Tsakonas, who's global head of shipping at DNB Bank. So, a great representation of the shipping finance from the global banks. Our moderator, Dora Mace-Kokota, who's partner with Stephenson Harwood. Dora, please.
Thank you. It's okay? Yeah, thank you. Well, Kevin has done the hardest part, which is the names and the titles. So welcome, everybody. Thank you to Marine Money, Kevin, Mia. Always a pleasure to be here, particularly in London. And what a panel, right? So I was going to start in a different way. And then on my way here, I read in Trade Winds something that said, a time of black swans and grey rhinos. Achieving objectives while confronting known and unknown challenges. So I'll start with a grey rhino, maybe, and loop back to what Kevin said a minute ago and ask the panel about liquidity. So we heard, and we have had discussions in the last few months and even today about excess liquidity in the market. What does the panel think? And if I can start with Stephen, can we challenge that? Do we agree with that? Is it excess, not excess?
Well, I would challenge it, actually. I mean, there is certainly a perception that there's excess liquidity out there, but I think it's much more nuanced than that. And why do I say that? I think there's two things. Firstly, banks have been seeing quite a high level of prepayments in the last 12 months, really reflecting the fact that ship owners have been making money, and with interest rates where they are, they don't want the carry cost of their loans. So on the one hand, banks are seeing prepayments. On the other hand, deal flow has been much slower. So when there is a deal out in the market, we're all pouncing on it and being very competitive. And that's what gives the impression that there's a lot of liquidity out there. But it is because there is fewer deals. I think the other thing I would say is that the European banks, we've reached an inflection point where I think we finally realised that Basel IV is not going to be good news for shipping. We're going to have to put a lot more capital behind our loans. And that is going to mean ultimately more cost to the ship owner. But the problem with that is that increased cost is very difficult to pass on when we have a large number of Asian institutions who are becoming increasingly active within Europe. So I think, what we're seeing is we're finding it quite difficult now to compete on pricing, which means that there'll be a withdrawal of liquidity as well. So I don't think it's quite as sort of black and white as perhaps you might think on a first glance.
Thank you very much for that. What do we think? What does DNB think, Christo? Is it the same or perhaps slightly more grey?
I think it's partly the same. I will agree with Stephen that yes, there are fewer deals around. That is correct. I will agree that it's a very strong market, so we see a lot of prepayments. But we do see a lot of capital around. You talk about Basel IV and the cost of lending going up, yes. But up until now, margins have been going down, and that is because there is a lot of capital that is chasing the same deals. And maybe European banks are constrained, but leasing houses have tremendous capacity. They've been getting a lot of repayments, so they are very hungry for deals. Export credit agencies, very hungry for deals. For smaller owners, mainly in Greece, we see Greek banks, at each other's throats, reducing pricing. So while in the medium term, it might be more difficult, for the time being, I certainly see tremendous liquidity in the market. And, if you look at deals that, some of us have been doing together, and, Gaslog is a good example, it was way, way oversubscribed. So, there is money for good projects, absolutely.
But I think it's the same amount of money chasing fewer deals. And under Basel IV, what is increasingly a driver for banks' capital is credit ratings. And that's one of the reasons why deals like Gaslog, Scorpio have been very successful, because they will fit much better in with the bank's Basel IV models than smaller owners who don't have such a strong credit rating. So I perfectly understand and agree with you, Christos, that they were great deals and were, of course, heavily oversubscribed.
Paul wants to say something.
Well, no, it's hard not to agree with Stephen or Christos, because I completely agree. But there's actually a difference between liquidity and actually using the capital. No one can argue with the fact that there's huge liquidity in the market today. Interest rates are high. Borrowers are not borrowing; they're prepaying their debt, as Stephen said. But things are going to change. Basel IV is going to be a real game changer. It's going to make it more expensive to provide capital, and we're going to have to get not just more bang for our buck, so that we'll have to be providing other services other than just plain lending. You know, lending for lending's sake, that has to stop. It's going to be about banking the client. So we're going to be looking to get more bang for our buck. And then, of course, we've also looked at the type of transaction which we're going to be lending to. ESG, of course, will play a massive part. So actually, yeah, the dollars are there, but will the capital be actually usable? And at the moment, I see it's going to be quite hard going forwards to actually allocate that capital and make the money. And let's be honest about it. If we can't make the profit on that capital and use it for the right reasons, that capital will be used by other business lines within the bank, and it'll be taken away from the shipping industry, which would be a real shame.
And is that then, so I've got a lot of questions on the back of that, but Vassilis, do you want to say something, or?
I mean, I think what's important is that what at least we have seen is a clear delta between the larger owners, if you wish, and then the smaller ones. And I think I do agree that capital is out there. At the same point in time, the availability of it, I think there is a misconception. And that's because if you see quite a few portfolios, for example, are shrinking and shrinking dramatically. At the same point in time, let's assume that you have $100 and you are amortizing X, Y, Z. A portion of that is being thrown at, to be deployed at any price almost from some of the institutions to the top owners. So there you're seeing contraction on pricing and potentially significant contraction on pricing on the back of effectively contraction of availability of capital from the, let's call it, European or the top tier, let's call it, shipping banks. So it's not that clear to be able to see, which is why every transaction requires very careful thought. And you could have enormous successes like Gaslog, like Scorpio, like others, but at the same point in time, you could also be on a total hit and miss. And also for, I think, the smaller owners, you could actually be in a situation where you have no availability of capital from traditional large shipping houses, and you could find solutions, but probably more on the leasing side.
So I was actually going to ask partly on what you touched. It sounds like what's happening is that we have the creation of sort of a bigger diversion between what I would call the main commercial mainstream European and international banks and shipping on the one side, and what we conventionally call, but I don't think they are anymore, the alternative financiers. And at the same time, perhaps a focus on stronger owners, operators, which are then causes a bit of a gap in terms of what happens for those that are in the middle or are not as powerful or not as good as operators. Anastassia, is that a challenge for ABN, or how do you see it?
So maybe, I'm not sure if this will directly answer your question, but I do want to try to answer your question and actually add to what has been said. So I think there's been a massive amount of capital, globally speaking, and investors have been searching for yield. Now, with interest rates moving, I think that picture will deteriorate. So all these, let's say, alternative capital sources, I think they might go to different industries. So I do believe that for shipping being a more, let's say, exciting industry where you do need to have higher returns, I think that we might see some capital outflows. That's one. And the other thing I want to say is that all this cash flying around, sooner or later, there has to be an acceleration in decarbonization, most probably forced by regulations, and that's going to be a quite expensive transition. And even though ultimately the end user will pay for it, everyone would have to chip in. So for me, it's the short term versus the long term. And then that, in addition to everything that has been said, you know, the capital cost of banks, the cost of equity. I mean, ship owners, okay, investing in fixed income, but if we expect interest rates to start decreasing as of June, so then bond yields will go down as well. So it's the short term versus the medium term that I think, you know, that's the constant dilemma we all have to reconcile.
Thank you. We've gone into a bit of black swan territory now with the interest rate discussion. Where do we think, you touched upon it a little bit just now, where do we think the interest rates are going in the longer term? What are you guys going to do about that? Or will you, or can you afford to do nothing? As that is one of the themes that I think Kevin wanted us to touch upon for the conference. Perhaps sort of more in terms of the, not just this year, but you know, the next year and beyond that. Stephen?
Well, when we talk about interest rates, well, I guess we're talking about two components. We're talking about the underlying SOFR rate in the case of dollars. And then on top of that, we're talking about, you know, the margin on top of SOFR. I don't see that margins can come down much from where they are unless we see a much bigger inflow of money from Asia. And that is happening to an extent, to be honest. That we are seeing that. But European banks under Basel IV will not have the capacity to reduce interest rates, interest margins. So if you then look at where we think, you know, US dollar rates themselves are going, well, I think it depends what day of the week you ask, because we're seeing very conflicting information coming out of the States. You know, non-farm payroll figures have been stronger than perhaps expected, which would suggest that interest rates won't go down. But then on the other hand, we see some weak data as well. My best guess is we're pretty close to the peak and we will see cuts later in the year. I think our house view is about 1.5% lower by the end of this year.
You know, I will agree, interest rates will probably go down, but we have to agree between ourselves that in today's market, with today's rates, interest rates are not a problem. If anything, higher interest rates are incentivizing people to prepay debt earlier. So maybe that is a consequence, but I don't think, you know, they affect investment decisions today in any way. I don't think they're putting stress on anybody in any way. So it wouldn't be at the top of our agenda, you know, I don't think at the moment.
Yeah, I don't think interest rates are the issue. I mean, they are going to come down. I'm not going to sit here and guess to what level, but there'll be more transactions in the market, which would be a great thing, I think, for the lenders who have capital to put to work. But for the reasons discussed already, mainly regulatory, I think what we're going to see, because there'll be more transactions in the market, we need to see more rotation of the portfolio, more distribution. This sort of almost like a legacy in the market where banks take and hold for 12 years is quite old-fashioned, I'd say, and it doesn't lend itself to the new regulatory environment. So it's not really an interest rate issue, but with more deal flow in the market, I can see much more distribution going on. And our clients will have to understand why that's happening.
And so linked to that, or sort of trying to look at it from the other side perhaps, when you see a good deal, you know it's a good deal. What does a good deal in 2024 and beyond look like? What are a couple of components that, you know, you definitely want to say, or when you see them you think, yeah, we'll go for that?
They have to be profitable.
Sure.
Well, of course they have to be profitable, yeah. And for them to be profitable, then we need margins to go up, or we have to increase what we call capital velocity, or we call it originate to distribute, or we have to see more ancillary business, or all of the above, I think is perhaps the point I would make. But what does a good deal look like? Strong credit rating, because that's important under Basel IV. A good sustainability story, because we're definitely competing within the bank for capital against other businesses which are perhaps, maybe ahead of shipping. And good structures.
I'm agreeing with Stephen again. That's great. I think it starts with the corporate. Strong credit rating, strong ESG story. They've got to have a commitment to the energy transition. I promised not to talk about the energy transition today.
I was just
and
about
I
to say,
apologise
it
to
took
everybody.
a long time and we didn't say ESG once. So
But Michael is in the front row here, so
Michael's
we do
there, had
feel
to.
obliged to.
But they do have to have a strong commitment and story towards that. That's starting point. Then you look at the vessels being financed. Of course, there needs to be some form of pathway through to alignment with what everyone's trying to achieve on the climate targets. And then, as I just said about distribution, I think with that playing a bigger role going forwards, maybe shorter maturities would help going forwards. So yeah.
Christos? Apart from profitability, are you covered? And Vassilis, from your, we discussed a little bit, and I would be interested if you wanted to share what we discussed in advance of the panel about sort of looking at the corporate as well as the assets. So I don't know if you wanted to share a little bit about that. It's not that it's the the make or the break, but I thought that was quite interesting.
Look, as an institution, this is what we've always done. So we are not asset financiers, never have been. Of course, you take security on the asset if security is there and you structure around it. But at the same point in time, we are corporate financiers. And I think that increasingly is coming into play with Basel IV for the European banks. And therefore, that is going to be driving weighted average loss norms, loss given defaults, and everything else. This is what has happened is there for Citi for a very long period of time, and you get some enhancement on the back of security. What I think is also going to be happening, and we're seeing it with Poseidon principles and many other things, but also velocity of travel of what I'm seeing from the US regulators and everything else, is in effect being able to measure the ultimate CO2 footprint of the corresponding portfolio in a notional basis. And I think that's going to be important, and therefore it's not going to go, I think it's already initial steps have been taken with regards to what is happening with Poseidon. So it's not only the senior secured positions, it's also the unsecured positions. It's everything else that you provide as capital to the corresponding entity. And that's going to come into play. And so therefore, it's not about financing the, let's assume that the corporate has, vessels which are extremely polluting, and yet they're doing a new building process, one or two or five. You will be looking at the corporate as a whole and judging it on a holistic basis. So therefore, strategy, vision, and what they're doing to address the holistic corporate emissions is going to be increasingly important in my view.
Same, different, Anastassia?
So some of you will not hear this story for the first time, but last week I had a meeting with a client, and my interpretation of what I heard is we are delevering. We have found some alternative debt resources, so we're trying to be basically independent from the banks, Basel IV, cost of fund, and I've been thinking about it for a whole week, actually. And my reflection today is that while I can see the point of this ship owner, and probably this concern is shared, I honestly believe that European banks have played a very important role for this sector, and they will continue playing because of the costs of the sustainability transition. And because we will be needed, if I would be a ship owner today, I would also think of some forward starting facilities, securing basically some liquidity going forward in advance of Basel, in advance of increasing funding costs. So first, you know, you prepare for a black swan, and second, you keep your banks happy.
Sounds sensible to me. In terms of, particularly for a moment, if we stop on the sort of more ESG side, you talked about, obviously, how you say the assets being important, the corporate being important. Do you see more investments coming, and do you want to see more investments coming on conversions, on, you know, additions, on other equipment, or do you want to invest more on new assets? What do you want to do?
Well, we are seeing, if you like, the good top owners investing in retrofits to their vessels. But typically that's silicon coatings, fins around the propeller, speed controllers, which is the right thing to do, but it's not going to get us to where we need to be. And typically they're financing those themselves out of their own cash flow, particularly at the moment when the markets have been so good. So they're not coming to the banks necessarily for that because the amounts just don't really justify it. Personally, I would like to see us talking more about extending the life of existing ships and doing, should we say, you know, heavier retrofits, whether that's a new engine or whatever it might be. But we're not really seeing that because there's so much uncertainty around, will one fuel prevail over another? Will it be a basket of fuels? And until we and of course fuel availability is the big question, I would say. Until we have more certainty around that, then it's very difficult to invest a substantial amount of money in a ship which may be, you know, 12 years old. But the statistic that I've heard, and I'll do my best to explain it, but I never explain it very clearly, but hopefully you will follow, is that if we build a new vessel, the carbon footprint that we create from building that vessel, it takes 7 years of the savings from the reduced fuel consumption to offset the carbon created from building it. So I think we should be talking about, you know, how do we extend the life of existing ships? How do we make them much more efficient? And don't get me wrong, I'm not criticising anybody who changes coatings and stuff, because that's probably as much as they can do. But the reality is it's not going to get us to where we need to be. We need to be much more adventurous.
I agree with Stephen 100%. And I think as banks, you know, instead of, you know, trying to incentivize people to invest in new buildings with random technologies that we don't know how they're going to pan out, yes, on an experimental basis, maybe that makes sense. But what we should be focusing on is trying to find ways to really extend the life of the ships, have meaningful investments on these vessels, until we have clarity on technologies and, you know, the right type of engines. You know, we heard in the previous panel about, you know, ammonia engines, etc., or methanol, or, you know, whatever ends up happening. You know, we need to have something that is stable. We need to have something that is investable, and then we need to start the conversion. We should not be incentivizing people to order ships with new ships, which contribute to emissions, with technologies that we are not certain about. And we should be, but at the same time, we should be pushing very, very hard for them to do everything that is available to extend meaningfully the life of vessels on the water. I think that's the right thing to do today.
Paul Vassilis?
No, I mean, look, I fully agree, and I also think that you have elements that we don't know. For example, you know, one is saying, okay, let's go with, you know, green methanol. Can we find it? Fine. The first element, can you find it? Probably not at the moment, or not to the extent that is required. The second element is it the best use of green methanol? Should it be available to effectively be burnt on operations of the vessels? Or whether it's much better to, you know, and I do think that increasingly we're hearing it with other clients of ours outside the shipping, and this is what's very beautiful about Citi, is that you hear these things from large other corporates, is that potentially you would be penalized if you were to be effectively, if those green molecules are required for a variety of uses. And therefore, what is important, and I think increasingly is being considered, is what's the best use of this extremely limited resource. And therefore, suddenly I can see from the discussions that increasingly you're hearing is, even if it is available, is it going to be used for effectively the shipping fleet? And or whether suddenly you have actual penalties, so therefore, you take that resource, you use it on something that is next door rather than ship it and then burn it on the back of a green methanol vessel. So it remains to be seen. So there's a lot that is changing dramatically, and I think I fully agree with Christos that people should be looking to extend the lifespan of the corresponding vessels with groundbreaking, if required, sort of retrofits. And, instead of trying to build vessels which you just don't know where it's going to go.
Paul?
Yeah, look, I agree with what's been said, but I also think that with a word of warning, because, of course we need to extend the life of the existing vessels, absolutely, with upgrades and retrofits, and the banks, including my own, are working on products and services to facilitate that. It's really, really important. But that doesn't mean we mustn't finance these alternative fuel vessels, because that's what's going to decarbonize this industry long term. And the targets which our banks have set, and I'm not talking about the Poseidon Principles, I'm talking about the Net Zero Banking Alliance and other commitments the wider banks have made. These are very, very solid targets which don't need to be hit. And again, the shipping teams of these banks need to hit these targets. And that's not going to be done by retrofitting older vessels only and continuing to finance conventional fueled vessels and kicking the can down the road. Yes, it's probably too early to stop financing conventional fuel vessels, because these can be retrofitted. But ultimately, we have to have a strategy. We have to focus on the alternative fueled vessels. That has to be the priority going forwards. And as part of that strategy, we should be looking at the right corporates who still feel that an investment in a conventional fueled vessel is the right thing to do. And of course, they've got a strategy towards upgrading their current fleet. But the way forward is to finance the alternative fueled vessels.
Sure,
But you cannot be looking to the banks alone to drive this, because the credit risk on financing a pure new technology vessel, absent a strong contract on the back of it, absent maybe some yard credit, absent maybe some export credit. If all parties come together and everybody shares the risk, absolutely, it makes a lot of sense. But you cannot be pushing the banks to say, this is a new technology ship, first generation ammonia run, costs 50% more than a conventional ship, no contract, go ahead and finance it. And I don't think any owner, will use their own equity to do so. Maybe there will be a couple of exceptions because, they have an ideal, because, they want to drive change, but it's not going to be in scale. For this to happen in scale, stakeholders have to share the risk, including the banks, but it cannot be the banks alone.
Anastassia?
And can I say one thing?
Vassilis.
I think you need both, right? It's not necessarily, we're not saying, I think, I'm definitely not saying that just retrofit, right? You need to be looking at what the new technology is. The question that I have is, what is it, right? What is it going to be sustainable? I mean, ammonia has significant issues with regards as a fuel, not as a cargo. So, a lot needs to be resolved. Green methanol is going to be available. And we're also seeing, and I have a lot of sympathy for the owners who, for example, and we're seeing it again and again and again, where they have LNG dual fuel, for example, in terms of capabilities. And there's not a single charterer that is going to pay a single dollar more, even though there are significant savings today. And we're seeing it live. So therefore, increasingly, and that's where I think things will change, is when the Scope 3 emissions commitments of the charterers, and ultimately for those that have the cargoes, are going to be kicking in, and the investors are beginning to look at it. What have you committed? Are you meeting it? So that at some point they actually make decisions which, today you can reduce, and of course invest in significant reductions going forward.
Do it, Anastassia.
So that's same ship owner told me last week, you banks, you need to sit together and not finance any new builds on conventional fuel. And I said, I wish the world was working this way, but I can see a certain point. So I think that's on the one hand. And when it comes to new technology, I think the public-private cooperation is very important. If I look at shipping, so we as ABN AMRO, but also other banks, we have this Sustainable Investment Fund where we co-invest with clients into new technologies. You see that a lot in the energy transition, and I wish to see it actually also in shipping. The technologies are not potentially as exciting, some of them. And there, for example, the question is, what return are we looking for, and are we willing, to put money not per se the highest return? That's what we see also with funds investing, for example, in methanol. I mean, something has got to give. And again, regulations and disasters will be the driving force. But ideally, we shouldn't wait for that, and that will accelerate. But it's just really, I very much believe in cooperation and trying different things. And yes, as I said, the public-private cooperation is very, very, very important. And I think in a very dispersed global market, that's not very easy. So that I think is a challenge. And I mean, I think we here together on the podium today, we bank a certain group of ship owners, but that's of course not the world fleet. How do we get to the tipping point?
Well, certainly from a legal perspective, and I know there is normally some delay in terms of you guys doing the deals and the deals then landing on our desks. What we see is very, very balanced in terms of the investment, where that goes, and how people work out where to invest. For now, I think in terms of what we are documenting at Stephenson Harwood, there is definitely a balance between the one and the other side. Stephen, sorry, do you want to say something?
Well, I just want to come back on a couple of points, if I may. Maybe to clarify, when I talk about extending the life of existing ships, I don't mean we do that just so that we can put on silicon coatings, etc. We should only do that if we're doing a major refit, and typically that will be a complete change in the type of fuel, and that would still be more efficient from a carbon perspective than building a new ship. So I think, Paul, I agree with you that yes, we need to focus on financing vessels that have sustainable fuel, but that could be through retrofitting. So that's the first point. The second point, and sorry for those of you who had the misfortune of hearing me speak before, but you'll have heard me say this on a number of occasions, I think we need to change the way we design and build ships. Now, I'm not a naval architect, but I do think we should be trying to make ships more modular in their design, so it's easier to swap out and swap in parts. If you look at an aircraft, you can do an engine change in a number of days. Now, again, it's different, they're hanging off the wings, I know, but why aren't we having the same kind of thinking when we're talking about new buildings? Why are we, coming to your point, Anastassia, why are we continuing to finance new buildings that only have conventional fuel capability with no optionality? If you order a ship today, you won't get delivery until, 26, 27, the 20-year lifespan, you're at 2050. And then the last point, maybe coming back to something that Paul was talking about, I do think that as an industry, we should continue to finance conventional fueled vessels, even if they're above the target, but be putting pressure on the clients to do the right things. The minute we disengage and stop financing these vessels, we have no bargaining position, we have no influence over the industry. So it's very important that we stay engaged and we do finance these ships, but on our terms. And those terms reflect what society expects of us.
Paul, closing remarks for you? Anything to add? Or?
Not really. That's the last point Stephen made about on our terms. I mean, of course, it's got to be negotiated, but financing conventional fuel vessels we have to continue with. But unless we do our due diligence on those and work out that there is a pathway to alignment going forwards and put the pressure on our clients to do what is required to align, then all we are doing is kicking the can down the road, and that will just postpone the coming on stream of the alternative vessels, and I don't think really that's in the interest of the sector. But that's not to say I'm not in favour of financing conventional fuel vessels. I am.
Christos?
I agree with everything that has been said. What we have to keep in mind is we represent on this panel a small subset of the financing of the industry. And I think if you reach to other parts financing this industry, they might have slightly more liberal or more relaxed views. So that's something to keep in mind, as well.
Vassilis?
Look, I'm cautiously but extremely optimistic. I mean, the opportunities for this industry is so significant. I think so much progress has been made, and I think we should be, talking about it openly, understanding the level of progress we have made, and ultimately, I do sincerely believe that, I agree with all the points here, but it's, the opportunity is also extremely large, and I think undoubtedly there will be winners and losers, but I think good projects, will be there, and the size of what is required is, we've never seen anything like it since effectively, post Second World War, where the whole fleet was not there. So it's
A lot to do.
a lot to do. Yeah.
Anastassia?
Well, things are impossible until they're done, right? So I'm a newbie in this sector, and actually thinking about the past 2 years, they've been quite exciting, and I think it would have been very different if I would have joined this industry 5 years ago. So I do believe that there's a momentum. We haven't reached the tipping point, but the direction of travel is extremely clear. It's just the timing of it. So, and I very much believe in directionally right, precisely wrong, and we're just going to keep on going. I don't want to repeat the rest, but so I'm cautiously optimistic and intellectually curious.
Excellent, thank you. That's a perfect place to stop, I think. Anastassia, Vassilis, Christos, Paul, and Stephen, thank you very much. Thanks for listening.